Hello everybody and welcome to Green Star Trading with me Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, for the next few minutes we're going to be looking at the IWM, which is the ETF for the Russell 2000. We're going to start by tidying up some Elliott wave counts and then doing some basic technical analysis. The first thing we need to do here is address a couple of counts that got invalidated, one of which I've already deleted the chart completely. Let me just remind you what it was, as we were observing it for quite a while. And that was the idea that we had a triangle form thusly, bear with me, A, B, C, D, E, and then I was suggesting that we had an impulse wave up here, 1, 2, 3, 4, 5, into a 1, and then we were looking for a wave 2 pullback, 1, 2, 5 waves in a C, except we went back beyond where the A began, where the 1, this would have been a wave 1 before the wave 1 began, beyond where the E finished, beyond where the D finished, beyond where the C finished. So this is wrong and I've deleted it. So that's gone. That leaves us with an alternate, which is this idea, which is still a triangle, but not very pretty. And I don't have any faith in this, to be honest. A teeny tiny bit perhaps, but very little. Purely because it no longer resembles a triangle. The C is above the A. We have a free wave swing here into the B, free wave swing here into the C. So we've still got the structure of a triangle, it just doesn't look like it anymore. We haven't invalidated 208 level, which is the bottom of the A, so we just have to put this on the back burner and say very unlikely, but still technically possible. You know, the only thing which could convince me that this thing was remotely likely would be a bounce off of the top trend line again below the B, another move down, contracting in the E, and then a further move bounce down. I was like, alright, maybe it is. Any move beyond the top of the B here invalidates it. So that's one thing to look for. Any move below the wave A, if we were to break down again for any reason, down here at the 208, spot 01, that invalidates it. So it's very much on the back burner now. So that leaves us two counts left, and I think it's very difficult to call primary or alternate in terms of giving one a bias or a preference over the other, because this is what happens when you move sideways for 150 plus days. It's very tricky to really call bull or bear. So let's just look at the bullish case first. The bullish case, which I put out in a video last week, maybe the week before. I put these two levels on the video. Red one at 209.16. This is the 23.6% retracement of primary wave 3, and this is the 38.2% retracement of primary wave 3. So as you can see, we put these levels up because we've seen previous support here, here, in the neighborhood here, and we came directly to it last week here, to the tick. So it's possible we've completed our wave 4. You know, we've got free wave swing in the W, double combo in the X, free wave swing in the Y, and now we're going 1, 2, 3, 4, 5, 1, 2, 3, or ABC, and then off into a 3. So this looks pretty promising, I'd argue, having found support here. So what we're looking for now is some kind of impulse wave. Now we could have a 4 waves complete here already. 1, 2, 3, 4, into a 5, into a 2, into a 3, into a 4, into a 5, into a 1, into a 2, so on and so forth. So we're looking to just see price action continue to impulse. Any new high here, I would suspect, I would say that we're in a wave 5 at that point. When it finishes, it only has to clear the wave 3, which is actually below this external correction, this swing ABC. It only has to clear the 3 to be a legitimate 5, so it doesn't even have to make a new high. I do think it will. I think that's highly likely. I've set a couple of targets up here. These are, let's just put a couple of labels on these. So price label, the yellow line here represents the 61.8% of wave 1 and 3 projected from 4, which is a typical target for a wave 5, and also we've got our wave 1 projected from 4, which is our white line here at 273.54. Whenever you get an extension in the wave 3, this is a likely target for the wave 5. However, in this case we had quite a long wave 1. We got an extension, but not particularly long in the wave 3. So there is, I'd argue, stronger argument for 5 to run You know, it doesn't have to. Like I said, the second it gets above the 3, it could fail, and we could have a very small truncated fifth. But I think it's more likely to push on into this target box up here over the coming months, and we'll see what happens. So this is how the bullish count interprets it. Any breakdown from here, you should be wary of the next support level at the 38.2 at 196.36. If that doesn't hold and we continue to impulse lower, then I think this bullish count is going to have to be called, or at least very much put on the back burner. Just because to have such sideways consolidation then break down suggests that you're no longer in whatever this was. You're in something new, and therefore unlikely for this to be correct. And that's why we have a backup, which is our bearish count. Now this is the count which simply refuses to die. You know, this is the count which says the Russell topped in March. Excuse me. And while the broader market S&P has pushed on time and again to new highs, and the Nasdaq, the Russell has refused to do so. It's just stayed below that March low. So this is the idea that we topped in a primary 3, primary 4, primary 5, very short-lived 4 or 5 in comparison to the very long wave 1, wave 3. This is the part of the symmetry that I really dislike. Long time in wave 1, short wave 2 though, long wave 3 in both price and structure, and time very short, very 4, very short 5. Seems a little odd. Not impossible. Now, because we haven't made a new high, this count's still valid. We have 5 waves down into a wave 1, 3 waves up into a wave 2, just below the start of the wave 1, 1, 2, 3, 4, 5 waves down. If you check closely, no overlap between the 4 and a 1, impulse wave here into another 1, A, B, C coming into a 2, like this. This will be the A, this will be the B, this will be the C, and then we will absolutely collapse in a wave 3 as we go into the 3 of the 3, and we break down violently. So if this is correct, a little time longer to complete a wave 2 correction, and this market will just completely implode, because this wasn't the 5th of the 3rd like I'm suggesting in the other markets. We can consider that and say that this is a 3, this is a 4, this is a 5 into a 3, you know. But then how do we explain this very long, complicated sideways correction? I mean, we're saying 1, 2 at primary wave degree. We've already got our option at primary wave degree, which is the correction's almost over. So getting the price to break down after doing all of this seems very odd. The only alternative from a bearish point of view would be that this is a 1, this is a very long, complicated, deep 2, and now we're going to get moving. That's the only bearish way I can see of interpreting this. I don't see any other way of interpreting it bearishly, so we'll have to wait and see what happens. Either way, 1 into a 2, 3, 4, 5 down into an A, 1, 2, 3 into a B, or A, B, C into a B, 1, 2, 3, 4, 5 down in a C, taking us way below the March low of 2020 in this uber bearish scenario. That would be, and that would be many, many months or longer, maybe a year or 2. But all of this is yet to prove anything, you know, and both counts will prove themselves as and when they do, and it will be obvious when they prove themselves, because we've been stuck in this range for so long that any violent acceleration down in an impulse wave down here, 1, 2, 3, 4, 5, I think we can only interpret as a 1, 2, 3. We'd be looking for 3 waves back and then down again. It could go even deeper. So breaking out this range to the downside with an impulse would confirm a bearish trend, and then the bullish is simple, which is we just make a new bloody high. We impulse into a new high. When it stops, nobody knows. We've got some targets for where it goes, but we don't know exactly when it'll stop. So that's it. We're still stuck in a range. We've put in another low on another support for the bullish count, suggesting that that could be the low, but we've had the low, the low, and the low before. So we've just got to wait until we get confirmation here. 5 waves up and 3 waves back here would be very convincing, and if you get the opportunity to trade it, I would advise, not financial advice, sorry, but I would take it if I saw 5 and 3 back. This would be a perfect pivot to buy. And you know, if you want to be a bear, you've got an option here. You've got 5 waves down, 1, 2, 3, 4, 5. If you get 3 waves up near the invalidation point, wait for a reaction, set your stop, get the reaction to the next lower high, and off you go. So there's short and long trades here available both ways. That has been the whole time throughout this whole range. This is one of the only benefits of ranging, which is we can continually look for pivots to buy and pivots to sell. You know, not my preferred method of trading, to be honest. I don't particularly like trading corrections. I'd rather get myself into an impulse, and preferably the third wave of one, down or up. That's all we're really looking for. So that's the Elliott wave count as I see it. Same old, same old. We've been going sideways, still are going sideways. Every time we come to support, that could be it. Every time we fail at resistance, that could be it. So I hope you get something from this. Let's do some basic technical analysis now. We're just going to hide the count, come out to the weekly, auto the chart. This really was a wild move up, wasn't it? Across all the US markets. Alright, so let's bring up our exponential moving averages: 10 in yellow, 20 in blue, 60 in orange, 250 in green. And our momentum indicators here on the weekly time frame. RSI set to a 10 close, green 30 level representing oversold, red 70 level representing overbought. 10 for the short term moving average, which we call the signal, and a 20 for the long term moving average. And red and green here on our histogram to show bullish and bearish momentum. So what can we see here on the weekly? Now, 10 has been rolling over, well, climbing and now starting to roll over. 20's been climbing and starting to decelerate. Price came up, checked for 20 last week with the wick, and closed the week to the lowest low, or the weekly close we should say, since March. So it was actually the lowest weekly close since March. So that could be significant. It could just be another retest of this support level which we discussed. So below the 10, below the 20, above the 60, above 250. RSI has been dying off gradually. The series of lower lows and lower highs, trending lower the whole time during this sideways correction. Not a lot of strength here at all. Short-term moving average signal crossover the long all the way back in March, and has stayed below since. A couple of darker red bars in the histogram showing some increase in bearish momentum over the last couple of weeks. You know, but this is just cooling off with time. You know, it doesn't look particularly strong, but it doesn't look particularly weak either. It's just what you don't lose in price. You know, you tend to correct like this, boom, boom, like that, or you tend to correct like this. Okay, so you either do it in time, like I think we've done here, or you do it in violent price movement. So for me, this still looks like it could be a sideways correction. You could have an argument that there's a double top in here, which is typical of a 1, 2. You have that, or you get a more obvious head and shoulders, which we don't have here, which is when you get a 3, 3, 4, 5, 1, 2, and then down into a 3, and you get a nice clear head and shoulders. This long deep 2, if this is bearish, has spoiled that pattern, or that pattern hasn't emerged as a result. Okay, so let's come down to the daily time frame. Alright, trading with a bullish wick, bullish candle here at the moment. Just around the 10 exponential moving average on the daily, below the 20, below the 60. Now when we've seen these before, so the 10 comes to the 60, so the 10 comes up, breaks down to the 20, touches it, here's the 60, we get a big bounce, big bullish candle. Then we come back up in the 10 comes down through the 20, and that signals the bottom here, comes back up, coils for a while, back up, comes down through the 20, here's the bottom here, comes back up towards the 20, here's the bottom here, comes back up through the 20, bottom. So as you can see, it's constant whipsawing. Each time these moving averages cross, we put in a bottom. The difference is this time, this is the first time the 10 and the 20 have gone below the 60 exponential moving average with the price below it, while the 250 is coming up to meet us. So are we just killing time? This is what's making it so difficult. We look like we're just killing time for a long-term average to catch up with us. But then we do have this bearish crossover here. Like I said, I don't often read too much into these death crosses and stuff because, as I pointed out, on longer time frames they can just mean longer term bottoms. On shorter time frames they can just mean shorter term bottoms. Sometimes you will get a signal which carries through, carries some weight and really breaks down. There is the potential for that to happen if the bearish count is correct. But there's also the potential for it to just mark another low before we go off to make a new high. So that's it, guys. I feel like I'm just going to go around in circles forever on this one, boring the hell out of you. It could be this, it could be that. At least we've gotten rid of a couple of counts. We don't like the triangles anymore. And we've got 2 strict levels of this range to look at. So just do that. All-time high. Oh, that's the A1 in it. So we bring up the... Yeah, so here's the 23.6, here's the 31.8 support, 38.2 support, 250-day exponential moving average. Any breakout of this range to the downtime and a downside and an impulsive move is bearish. Any break to new all-time highs kills off the bearish count, leaves us only with this count to push higher. So it will happen sooner or later. Alright guys, thank you very much for joining me on this technical analysis of the IWM Russell 2000. If you're new to the channel, if you like what you've seen, please subscribe, smash the like, leave us a comment in the comment section below. If you want to, hit the little bell notification icon to remain informed of future video releases. Right, if you're a patron, thank you very much for your support. It's greatly appreciated as always. If you are interested in becoming a patron, and you head over to the link below in the description, have a read of the tiers. If you see anything you like, please bear in mind it's better to leave it now this late in the month until the 1st of August, till the 1st of next month, because you will get charged the day you sign up and you'll get charged at the start of each month. So best to avoid getting charged twice in succession and just wait for the start of the month when it's this late. Be working on the dividend calendar and stock rating system for August. That'll be out for the 1st of August as well for tier 3 patrons. And if you're not following me on Twitter yet, there's a link in the description box below. Go over and do so. Alright guys, take care and I'll be back with you during the week. All the best. Bye bye.